Euro at parity to the US dollar. What does this mean for crypto? After 20 years, 1 USD equals 1 euro. And you know what that means. Paris, Rome, and Amsterdam will get a lot more business from overseas. The euro dollar parity means not only cheaper holidays for Americans, but also there's going to be some macroeconomic consequences and implications for crypto. So in this video, we're going to take a look at the grand scheme of things, so the big picture behind the exchange rate movements, and also why $1 equals 1 euro now, the three factors explaining this development, and also the ECB's battle plan, so the situation that the European Central Bank finds itself in. And also, what does this mean for crypto? Is this the bullish or bearish case? And where does the digital euro fit in? And we want to hear your opinions about the euro dollar parity in the comments below. So let's just get started. Euro dollar parity, what is happening in the grand scheme of things? Three big developments set the stage for this once in 2 decades event. Rising debt burdens following the COVID stimulus packages, and also rising energy prices caused by the war in Ukraine, and also supply chain issues caused by COVID lockdowns have led to a scarcity of goods and labor. So let's talk about number one, rising debt burdens. Governments, like consumers and companies, finance spending with debt. Modern economic theory says to save in the good times and spend in the bad. Unfortunately, theory doesn't square up with reality, and government debt has been rising quite a bit in the last decades. Here you see a comparison of the debt to GDP, i.e. the economic output of a country for the Euro area and the US. Eurozone countries were a bit more prudent with their finances than Americans before COVID, but that went out the window with the pandemic. So why is this important? Well, more debt equals more money spent on interest rate payments, which means less money spent on other things. So since governments are profligate, they can either save to reduce debt, rare but it actually happens, or take on new debt. And that happened over the last few years. And number two is rising energy prices. Just when COVID seemed well and truly behind us, the world economy got the next low blow. The war led to higher fuel prices, meaning less consumption, savings, and investments. Energy prices drive higher costs and inflation happens. Inflation devalues your money. The government struggles to combat inflation already because of high debt burdens. And number three is supply chain issues. Shipping during the pandemic was more difficult, causing supply chain bottlenecks. And we saw this in automotive chip shortages, labor shortages, and fears over up-and-coming potential food shortages. Less supply of important goods and labor leads to rising costs, which rises inflation. Now, what is the connection between the euro-dollar parity? The three main reasons behind the euro-dollar parity. Number one is interest rate differentials. Rising inflation can be curbed by tax rises, which are very unpopular, or interest rate hikes, which are much more easier. With the latter, the government makes holding a currency more expensive by issuing debt with a higher interest rate. And the Federal Reserve has been doing exactly that and raising interest rates fairly aggressively. The European Central Bank, or ECB, has not. And investors face the following choice to escape a 8% inflation. A, keep cash in dollars and lose 8% on it. B, buy US bonds and receive a 1.5% and lose 6.5% on it. C, keep cash in euros and lose 8% on it. Most investors are actually choosing B. Even more importantly, most investors predict that most other investors will continue choosing B in the next few years. And the dollar currency index, or DXY, is a testament to the rush into the greenback. The dollar is likely to extend its bull run over the next few months, considering the interest rate projections for the coming months. And number two is growth fears in Europe. Oil and gas prices around the world have spiked as a result of the war. However, they have spiked much more in Europe than in the US. Lynn Alden pointed out that predicted higher prices over a longer period of time in the future could do real damage. You don't have to be a PhD in economics to understand that this is bad news. Higher gas prices means higher prices for consumers and higher prices for energy-reliant industries. Unfortunately for Europe, its biggest and most important industry specializes in manufacturing. Number three is Germany's reliance on acceptable energy prices. GDP figures for the EU 27 countries show that Germany's share of the EU's GDP is more than 20%, even more if we consider only the 19 countries that are in the Eurozone. Germany is economically roughly as important to the Eurozone as California and Texas are to the US combined. Unfortunately for Germany, the days of importing cheap energy from its favorable supplier Russia seems to be numbered, and so are the days of exporting machinery and cars back to Russia. Although Germany has plenty of other bigger trading partners, the hit was substantial, and Germany registered its first trade deficit since 1991. So how does the European Central Bank plan to actually tackle the euro-dollar parity? The market thinks that it won't even try. Investors expect fairly tame interest rate hikes until the end of 2023. European Central Bank President Christine Lagarde has done little to dissipate doubt.
But how do you get it?
It will
back?
come. It will come. In due course. Yeah.
And not everyone in the European Central Bank agrees with this dovish course, i.e. staying passive. Austria would like to see the problem tackled more aggressively, but it's doubtful if that's even possible. Southern European nations like Italy already have to pay a significant premium to borrow money in the markets. In short, it's complicated, but it doesn't look like the euro will reverse course anytime soon. So what does this all mean for crypto? According to a Chainalysis report, Europe's share of the global crypto transaction volume by region was 25% in June of 2021. Even if that figure slightly went down as a result of the bear market, Europe accounts for a significant part of crypto transactions. Most of the growth was driven by large institutional investors entering DeFi. In other words, Europe is an unexpected crypto hub, and if Europe is down, crypto is down. Unfortunately, it's not as easy as saying a weak euro equals crypto down bad. A weaker euro could actually have little to no impact on institutional investors and those that just look at the big picture and how the industry is doing as a whole. And more interesting, however, is the European Central Bank's stance on cryptocurrencies. European stablecoins like EURT have barely any significant circulating supply, only 400 million EURT compared to a 65 billion USDT. But that didn't stop the European Central Bank from speaking out against cryptocurrencies and in particular stablecoins. The European Central Bank considered the latter inadequate for use in real economy payments because of their speed, costs, and redemption terms. It proposed supervisory and regulatory measures as something the European Central Bank likes to tinker with, unlike its interest rates. And the European Central Bank also showed a lot more enthusiasm about CBDCs or central bank digital currencies than about its monetary policies. A digital euro, as the proposal goes, could be capped at 1 to 1.5 trillion euros, and it just so happens to be the amount of cash in circulation. What a coincidence. However, the proposed digital euro coming to a European jurisdiction near you in 2026 did not meet with positive market feedback. Techifying crypto proponents labeled it as a slave coin, although the CBDC is supposed to be anonymous. Still, it would at least theoretically allow new monetary policy tools like targeted cash allocations and negative interest rates, the stuff pro-crypto folks' nightmares are made out of. So what's the conclusion? Well, the euro-dollar parity is likely here to stay, and at least in the next 12 to 18 months, the Fed and the European Central Bank are going down different paths, so don't be surprised to see even more dollar strength in that time frame. The effects on crypto are less clear. An economically weaker eurozone doesn't help, but how much damage it could actually do is yet to be seen. And at least euro-bound crypto investors have stablecoins as safe fiat havens.